Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been America's foremost precious metals brokerage firm since 1972, helping you build a strategic precious metals portfolio. Call 800-525-9556 to buy gold, silver, platinum, or palladium today, or go to McIlvaney.com. Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. And we are honored to finally get Miles back on the show here after kicking a little COVID. Can we say that?
Yeah, I think we can say that. Yeah, it's good to be back in the studio, Tori. Appreciate it.
We're missing Robert, but that's not why
we're missing Robert. But that's not why.
Let's not start rumors.
Yeah. He had his COVID 6 months ago, so he's good. And I finally got mine, and we'll continue to pray that you never get yours. So appreciate you holding down the fort the last couple weeks very much. And there's been some interesting gold news. Gold currently sitting at about $1,782 here on Wednesday. We've had gold consolidating for a long time now, but a real tight consolidation since the summer between about 1830, and we did have that low down at 1676, but it's really been around 17 and a quarter. We've had this $100 move up and down in gold since about May and June earlier this year. We're sitting right in the middle of it, 1782 on the upswing. And my argument would be we're probably going to see gold move up to at least 1800, maybe slightly above it over the next couple weeks, and test those previous highs around 1833. That would be the first ceiling that we need to break through, similar to what we're going to look at here in silver in a minute, which has had a little bit of a move up. But we are going to need to see gold give us some upside momentum, breaking above 1833 and then moving towards the 1900s.
Boy, I sure thought we were there last week, and it all kind of unraveled on Friday with China coming out on the Evergrande issue and their real estate debt concerns and default concerns, which are now becoming a reality. But we had creeped up over that $1,800 mark temporarily on our way to that 1830. Thankful that we're in a new channel here, and I'm sure you'll point out how previous ceilings become new floors a little bit. But here we are clawing our way back up after that big Friday and Monday weakness, despite all the fundamentals remaining the same, dollar strength and oil and inflation numbers. But anyway, let's transition over to the next image.
Right, and I think it's a key theme, what you just said. You know, old highs become new lows, old lows become new highs, depending on the direction of the market. And just wrapping up gold, I mean, we've been looking at a gold floor at 1675 dating back to May of 2020. But we've had consolidating highs up around 2075, you know, almost 2100. 1960, 1913, now 1830. So we've had a very consistent flat floor and a declining ceiling pressing those prices down. Now that doesn't necessarily mean you're going to guarantee a breakout one direction to the upside or the other to the downside, but it has been consistent that the floor has stayed firm while the ceilings have stepped down. And all gold really needs to do is to break any of those ceilings, even the tightest one here at around 1830, and then you should start seeing exactly what you mentioned, the stair-step pattern up, where we start overcoming some of these previous price levels, 1913, 1960, and then ultimately around 2075. And we're starting to see that same sort of momentum in silver. You know, silver put in a pretty firm bottom just under 22, and 22 was a number that we were talking about 6 months ago. So to see it come into that number and have a pretty strong bounce up from around 2150 all the way up to 2430, which is where we're currently sitting today. We broke through a reversal 382 fib on the upside. I had a chart up on your show last week, Tori, showing the type of pattern you would want to see silver play out, where we maybe have a step up to the mid-25 range, a reversal back down, establishing that new floor at around 24, 2480, somewhere in that range, and then take the next step up to overcome the next ceiling. So just like if you look here on the silver chart between, say, June and October of this year, you had a very clear stair-step pattern down, 3 or 4 steps down. I would like to see silver start making some steps up, and we're getting very close to arguing that first step. We're at 24.30. The previous high was at 24.86. So if we get another 50 cents up and it holds up, maybe even moves $1 up from here, it's very likely we've had a breakout move to the upside. then all we would need is for it to put its foot firmly on around $24 and then keep going from there.
Well, and that actually may be where you get the elevator ride. It may, just like in 2011 and then going further back to 1979 and 80, where you get a stair-step pattern until suddenly you don't. And it's not that you fall, it's that you get an elevator up and it goes up multiple stories. And that's what we've seen in those major cyclical events, is a parabolic move up, similar to what we saw in 2020 post the COVID decline in silver all the way up to its previous highs. That's sort of an elevator ride and not a stair step. And again, there's a sea change in the underlying fundamentals. But I fully expect, if you go back and recreate those charts from the 70s and then 2008 to 2011, and you'll see what we're talking about, where it can actually recreate that aggressive parabolic move if we do see silver go back and flirt with its previous highs.
Oh, absolutely. I think most of the, let's call it noise, that you're going to see in the markets, most of the back and forth is probably going to happen between, let's say, 24 and 28 in silver. You know, once we get up to 28, 29, 30, well, now the only previous action that you're contending with is action from more than 10 years ago.
Yeah.
So there's not going to be much in the way of standing orders or orders placed as price was moving through that range, because that price hasn't moved through that range in a decade. So, and that's, like you said, with COVID, that's exactly what we saw. We saw some bull versus bear combat taking place in the markets until we reached a point in, say, March of 2020, where we hit this bottom, and then all of a sudden you have this flash flood. I like your analogy of an elevator, just taking it from $17, $18 silver all the way up to 30. And next time it doesn't go from 17 to 30, it starts at around 28 or 30, and it probably runs up to 50 before we start the cycle over again.
And when that happens, again, our eyes are going to be on the ratios. So in that 2011 timeframe, that's the last time we saw silver dip as low as 32 to 1 in regards to the gold to silver ratio, which is what we follow more than we even do the nominal price. Well, in the last 10 days, we've had a ratio decline all the way from a little over 80 to below 74. So we've had about a 7.5 point swing, which maybe this is the beginning of a parabolic move. We'll have to see. I love the fact that we're at 24.29 as we record here, and that we're holding that new floor that you're saying could ultimately be something that we run away from and come back down to touch. So you've got to hit this point and close here before you can start to get optimistic about the stair-step effect. But all that being said, remember, it's about the ratios as well. So as we're structuring portfolios right now, whether it's in an IRA or a storage account or sending something to somebody's doorstep, we really have to have some white metal exposure in order to compound those gold ounces in the future, to take advantage of the fact, like what you've seen here with the 7-point contraction in the ratio. That's going to absolutely continue. Do we go back to 32 to 1 like we did in 2011? Hopefully.
Right. And with that nominal value, would you rather care about the nominal value of 1 ounce of gold or 2 for the same amount of money? And that's the benefit and just the power of compounding ounces over time in these relative values. So other white metals, platinum sitting at around 1051 as we record here on Wednesday. But another fantastic example of old highs, new lows, and vice versa. 1032 has been a market low and a market high in platinum between June and September of this year. And we just broke above that price and very briefly came down and have placed our foot on it. So it's very likely we could see platinum continue to step up. The next move up would probably take us to around 1145, which we're hitting the next ceiling, which of course you and I hope becomes the next floor as we break through 1145 and keep going from there. So platinum has actually put in a higher high, which, as we just looked at in the charts, gold and silver are both very close to doing, but haven't done quite yet. Platinum actually has, so that's very encouraging. And if platinum can stay above around 1030, maybe even move up to around 1100 and then come back down and retest it, really show the markets that they're placing their foot on the ground. The platinum market is ready to take that next step up. And talk about a ratio that still is of great benefit, the platinum to gold ratio and the platinum to palladium ratio.
And
while
the platinum
tightened,
to silver ratio.
yeah, while they've all tightened, especially platinum to palladium with the big drop in palladium we've had, platinum is looking like a very important part of a portfolio going forward.
I feel great about it. I feel great about where it bottomed here lately, and I feel great about how quickly it came up to these levels. And all that to be said, I also feel very strongly that we will see parity in its price with gold. We don't even have to go to double the price of gold like we were in 2008. That wasn't very long ago, 13 years ago. Platinum was $2,000 an ounce and gold was $1,000. So I feel that good about it to where you've got to have a minority position of platinum in your portfolio.
And one last thing I do want to point out in the markets, if anybody's been paying attention to the television, you've probably noticed that the Dow Jones back up over 35.6 and flirting with the all-time highs again. The Dow Jones has had a great strong move up since about the end of September. But more importantly, this is something that we pointed out a while ago, is we saw a disconnect going back to June, where the Dow Industrials continued to climb, but the Dow Transports continue to fall, in fact, dropping from around 15.8 all the way down to 14,000. It's a pretty significant move, almost 2,000 points on the Dow Transports over the course of a couple of months. Well, the Dow Transports have screamed up over the last couple weeks since the beginning of October. So it looks like those two markets are trying to link back up again, which is a good thing. You want the goods you're manufacturing to be shipped. So I think it's important to you're laughing.
It's a timely wish.
Wrong?
It's a timely wish.
Yeah, am I wrong? You want to make things and then you want to send it to people who paid for it. Both of those are important parts of the sales process in any industry.
Especially around the Christmas season.
Yeah, especially around the Christmas industry.
Small
and maybe
business.
That's it. Maybe we're seeing a ramp up in the transports due to the Christmas season coming around the corner in the next couple of months. But I'm going to continue to watch these two markets because I think that they are as married as any two markets can be. And finally, I think a lot of this, of course, is predicated on the U.S. dollar. I know you and Robert went pretty deep into the dollar last week, so last week's show is a great discussion there. But lo and behold, we came right up into the 382 fib and we turned right down. So no surprise there. The dollar is off, only marginally, not enough to get excited about. But if we were to see the dollar continue down, maybe into the 92 or, the 91 range would be real ugly. And we're only at 93.6 now, so that wouldn't be a massive move down in the dollar. But from a charting perspective, it would be pretty significant. And the fact that from the high of 103 back in 2020 to the low of 89 at the beginning of 2021, if we're only able to recover about 38% of that, a 382 fib, and if the dollar were to continue to decline from here, it just adds a lot of weight to our argument that the dollar is really dying on the vine over the last decade. And I really would like to see the dollar show a little more strength, get up to 96, get up to 97, show the world that the dollar still holds some clout internationally. But if it were to continue down from here after having the most shallow of potential corrections back up, that would make me very nervous going forward for the purchasing power.
Well, a lot of that's going to depend on what the euro does. So we've talked on this show about the dollar index, but over 50% of the dollar index relationship or the dollar measurable value is impacted by its relationship with the euro, and closer to almost 60%. So if the euro is ailing, then that actually bolsters the dollar in that relative relationship on the dollar index. It does not mean that the dollar's healthy. It just means it's not as weak as the euro. So the euro, with their debt concerns, with their negative interest rate or zero interest rate policy that's been continuing for years now, with their inflationary pressures and their economic slowdown, they're having a lot of the same issues that we are having, but the euro's taking an even bigger hit. So if the dollar's going to weaken further, it's going to be the Eurozone or the European Central Bank doing things like tightening, or the euro having somewhat of a rally. That can drive it down. And then nominally, gold's measured against the dollar here in this country. You'll see the gold price increase in U.S. dollars when that happens. They're both dying. The euro and the dollar are dying on the vine, right? It's just
Right.
One's dying faster. They're dying at different rates.
Well, and they're trying not to. You're talking about two different major economic powerhouse zones that are both doing the same thing. They're both fighting to prove the same college thesis that you can Keynesian manipulate currency. and fix your way out of problems.
Well, and you can't right now. I mean, we talked last week about stagflation being the word of the week in a sense, right?
Right.
Well, if you've got inflation and a stagnant economy, if you go to just fight the inflation, you can stagnate the economy even further. You don't want that either. So there's this fine juggling act that they're having to do. People say, well, when is gold really going to take off and run? Well, it's going to take off and run when the dollar plummets. Okay, well, when is the dollar going to plummet? Well, the dollar's going to plummet when they get aggressive about monetary policy, things like interest rate hikes, things like tapering the Federal Reserve bond buying program, or reducing the debt, or reducing spending, pausing quantitative easing. Are those things that we can afford to do economically right now? We can't even get containers out of the ocean and into the ports. So you've got this stagnant economy, and if you do those things aggressively right now, you will crush the economy. And we started to see it roll over even during the Trump administration when they began to do things like tapering, the taper tantrum.
Right.
So I don't see that strong dollar policy really happening right now. But as the economy can start to heal and heat up, then you'll see that, and you can actually have the economy starting to roll again and inflation pick up steam to where they have to do things like raise interest rates, aka the 70s and 80s under Volcker, when he had to come in and aggressively raise interest rates in order to fire extinguish the runaway inflation.
And in the meantime, on the other side of the Pacific, there's about 1 billion Chinese people who just keep buying more gold every year for the last 20 years, as if they see the writing on the wall at some point down the road.
That's right.
So
there's another systemic issue, too, with the global economy, and that is China.
Yeah.
And you've got to listen to the
buying
last few
American
weeks of
businesses, buying European businesses. So
building
they're buying
houses
infrastructure.
that aren't taken up,
Yeah.
right? Nothing's lived in. You got to listen to the weekly commentary for the last few weeks and get a real sense for that. Read the Credit Bubble Bulletin, and you'll understand why that's a modern-day systemic risk that makes Lehman Brothers look tiny.
Right. So you've got this national pressure coming from the Asian markets where they're coming in and they're buying raw materials, material producing companies, finished products. They're buying the infrastructure of businesses, and they're buying precious metals. And we're over here nickel and diming our trillions of dollars worth of interest rates up and down, just trying to keep a paper economy afloat, while they're converting as much of those paper assets into real tangible products as they can. And I think that's something to pay attention to over the next 10 years.
It is, and so is this everything bubble. Before we close, I just want to point out again, you talked about the Dow being at an all-time high. The Dow, the S&P, the NASDAQ just looking healthy. 89% of that is owned by the top 10% in the country, by the way, and most of that has been driven by share buybacks. So it's a shell game. Bitcoin all-time high. Housing all-time high. Oil near an all-time high, certainly a decades-long high. So you've got this everything bubble that's occurring, but what's not? Gold. What's the most value in the markets right now? Gold, silver, the precious metals. There's an inverse relationship. You're looking at this opportunity to know that this everything bubble is going to burst. Gold is not overvalued right now. It's incredibly undervalued compared to those other assets.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell, join us in the comments if you have any thoughts, questions, concerns. You can find more info on our website at McIlvaney.com. We're on Twitter at ICA Gold or Facebook at McIlvaney Financial. And as always, if you'd like to speak with an advisor at McIlvaney ICA, you can give us a call at 1-800-525-9556.
Thanks for listening. Have a great week.